The Federal Reserve just announced it will start tapering its monthly bond purchases later this month. What's the worst that could happen?
The potential for a sharp backup in rates that Fed isn't prepared for and the markets are definitely not prepared for seems very real to me.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. Right now, we're living in a world of all-time high asset prices. Just look at stocks, housing, or cryptocurrencies, just to name a few. They've all rocketed higher in 2021. Wages are suddenly rising faster than they have in many years, too. Are these the new roaring 20s? Will we enjoy a prolonged period of prosperity from here? Or is the current party not sustainable? Skeptics worry that spiking inflation, fast slowing economic growth, accelerating wealth inequality, snarled supply chains, energy shortages, too much leverage, and too much financialization are putting the system at danger of another reckoning like the Great Recession. Who's likely to be proven right, the optimists or the skeptics? To delve deep with us into this is Stephanie Pomboy, founder of MacroMavens, a preeminent economic research firm, and one of my most favorite people to interview. Stephanie, thank you so much for joining us today.
It's a pleasure to be here as always, Adam. Thanks for having me back. I'm looking forward to the conversation. We picked quite a day and time to convene for this conversation.
We did. Perhaps even by the end of it, we might know what Jerome Powell says today, but we probably are going to finish right before he takes the podium. All right, Stephanie, well, look, let's start with the question I began with the last time I interviewed you. I just like to ask all my guests this at the beginning. What is your current assessment of today's global economy and financial markets?
Oh boy. Okay. Well, way to start with the
easy one.
The depressing one right out of the gate, right? Well, to the extent that I've been sort of chronicling this ever-expanding wedge between asset prices and the fundamentals ever since you and I started talking, my current outlook is only different from my previous outlook to the extent it's even more dire, because I do expect at some point there's going to be a reckoning between those two, between perception and reality, and that won't be pretty. Of course, figuring out the timing of that is impossible, but I'd rather, not try to be clever enough to figure out the exact moment and just stand back and let other people try to play that final blow off phase, which I keep thinking we've seen 37 times already, but they just keep coming. So in sum, my outlook is that we have a very fragile financial backdrop for the markets, and that will ultimately set up some real potential destruction for the global economy.
Okay. So I pulled a quote from the last time we talked where you said, quote, you'd never seen a time when the markets were so far afield from the economic reality on the ground.
Yeah.
We're about a year later from that interview where you had said that with me. And of course, we're just even farther afielder today.
Right.
So I was going to ask you, do you think something fundamental's changed and we're just in a different new normal? Or do you see that we just now have more altitude for the snapback that must come? It sounds like you think the latter.
Yeah, I mean, I don't know what would have changed that would justify the valuations we're at. I mean, I guess the only thing that people could imagine, which I guess is the consensus, is that the fundamentals are going to suddenly ramp high enough to justify the level to which asset prices have already climbed. But that's a Herculean feat. If you just look at the very simplest metric of valuation, you look at that Buffett indicator of market cap to GDP. Today in history over the last, in the post-war period, The market cap is averaged just under 80% of GDP. So today, GDP is a little bit more than 20 trillion. So you're talking about a fair market cap of 16 trillion. Last I checked, the Wilshire was trading around 48 trillion. So, I mean, it's insane. Let's say we have the 30 trillion excess value, fluff in that market. Unwinding that would be absolutely devastating, obviously. And that froth, that bubble, is far bigger than it was at the bubble of all bubbles, the dot-com bubble in 2000. I just went back and looked at that, and the market cap, the excess valuation, then today it's 30 trillion. Back then it was 8 trillion. And at the time, total GDP was 10 trillion. So you were talking about, a hit, let's say, of 80% of GDP. Today, you're talking about a hit of 130% of GDP. I mean, there's just if we do go back to any kind of reasonable valuation, it would be absolutely devastating.
All right, yeah, and to your point, it sounds like the two main arguments for presuming that prices could have reached a new normal, that assumes that either the economy is going to be growing faster than it is today to support that. And in just a moment, I want to ask you about the economy because it's actually quickly decelerating. It is slowing. Or that, there's been so much stimulus pumped into the markets or into the system that's found its way into financial asset prices, where one could make the argument that, okay, if they just keep those stimulus pumps running, they could keep prices higher. And maybe we'll talk about that too, but it's certainly looking like, Powell, perhaps in just an hour or so, is going to come out and say, hey, we're serious about tapering, because that's the game he's been talking. And Congress is having a harder and harder time getting additional fiscal stimulus passed now. It doesn't have the political air cover or support to get the many trillions it passed last year. So it seems unlikely. My point is that the stimulus spigots are going to continue going forward the way that they have. So that opens up a bunch of questions. But first, let me just start with inflation, because that is something that's been new this year. And we can largely tie it to that stimulus. We can also tie it to some breakages in the global supply chains, et cetera. But that has been a new factor this year. Does that change your outlook at all? In other words, does it either make you more worried about a coming correction, or does it stave things off for a bit? How does inflation change the way you're looking at the macro picture?
Well, I think to the extent it changes it, it makes it more dire, and it probably brings the urgency or the risk sooner. And so for a couple of reasons. Number one is just from a very broad sort of nerdy macroeconomic analysis. Think about, pump all the stimulus in, monetary and fiscal, and the idea is to get the economy going. But demand was so slack during that period that the money had nowhere else to go but into assets. So all the excess liquidity, let's say, flowed into assets. As prices go up, consumers have to spend more just for their basic everyday necessities. So the economy is sucking in more of that liquidity at the margin because inflation is trying to catch up to the high inflation numbers. That at the margin is sucking liquidity away from the markets. So the more and more inflation goes up in the economy, the more and more inflation goes down in financial assets. And I think of that as kind of a tug of war. If you keep stimulus the same, the two forces are going to go back and forth, pulling and pushing depending on the demand and inflation pressures in the economy versus the markets.
So sorry to interrupt, but can I add a question to that, which is, do you also have the additional effect of on the financial markets? Not only is rising inflation sort of stealing capital from the financial markets, but it's also depressing profit margins at these companies.
Absolutely. So there's that, which is a rich topic that I love to go into, because it's not one that, judging by the markets, anyone really believes is an issue. You listen to these earnings calls in the third quarter, and people feel like, oh, look, they're getting pricing power, they're passing on prices to the consumer. But if you just stand back and look at the CPI, the consumer price index, versus the PPI, which is the input cost that all these businesses are facing, the PPI is running twice the rate of the CPI. So sure, plenty of companies are being able to pass on some of their price increases to the consumer, but there is a massive margin squeeze going on behind the scenes that people aren't really paying attention to. And I think companies have been able to disguise that so far. They've, wrung as many efficiencies as they can, and they've raised prices a little bit. But they're not going to be able to play this game forever, especially if, I know we'll get to this later, but especially if the stimulus bill that's currently being proposed goes through with that tax on buybacks. Admittedly, the tax proposal is just 1%, but the journey of 1,000 miles starts with a single step. Make no mistake, once they get the door open to raising a tax on buybacks, that will be their source of funding for every spending program they want in the future. And buybacks factor into this earnings thing, because when you're able to buy back your shares, you can inflate your earnings per share earning metrics. And that's why I've always focused on the government accounting of profits, which is just a dollar profit level rather than the per share number. This all gets wonky, but the point I'm getting to is that if you looked at what's happening with corporate profits as reported by the government, you get a very different picture about how corporate America is doing today than you do listening to the companies reporting from the S&P. So we can get into that path more. But the third thing I would, getting back to the question about this increase in inflation and how it factors into my outlook, the third factor beyond sucking money out of the markets into the economy and depressing corporate profit margins, the third potential factor is pushing interest rates higher, which on a highly levered economy could be the death knell. So I think it's very interesting to watch how complacent the markets have been about the Fed's tapering, which they view as, they buy the Fed's assurance that tapering isn't tightening. It's just a gradual removal of accommodation, and that they're not going to raise rates until, who knows, if we'll get a window into that today, but it's sometime next year or even the year after. But that's all just a sound and fury signifying nothing, because when one of the largest buyers of treasuries starts to gradually slow their purchases and issuance keeps going bananas, this is basic supply and demand. The outlet is going to be higher interest rates. So they can say taper isn't tightening. I think we'll see shortly that is not true whatsoever. So there are three ways in which the inflation could really hit the economy: by, letting interest rates go up, no longer suppressed under the thumb of the Fed. Anyway.
Yeah, well, great point. So first question is do you, like, how near term a threat do you think that is? Right. So, a lot of people I've talked to, or a number of people I've talked to, have said, look, the Fed may be forced to tighten eventually if inflation keeps rising the way that it is. They absolutely do not want to tighten, right? They might taper.
Right.
They're saying we're going to taper, not tighten, but they may actually be forced to tighten if inflation really continues to rage for longer than they want it to. But what you're even saying is they don't even the Fed doesn't necessarily have to tighten for interest rates to go up.
Right.
So, kind of looking ahead, when do you sort of think interest rates could start to creep higher? Is that something you think could happen, next couple of months, next year? It's not for years. What do you think?
It's, the tricky part is trying to figure out what is the safe haven demand for treasuries going to be in whatever, environment you're talking about. So right now, there is no fear, so it's all risk on. So there's really no safe haven bid for US treasuries by US investors. And for that reason, I think the taper could have the immediate effect of pushing interest rates higher, just because who's buying 10-year treasuries at negative real interest rates,
Right.
when you can buy Tesla or all these other meme stocks.
Right. And
So
sorry to interrupt, but deeply negative real rates.
yes, right, exactly. So I think that the prospect of an increase in rates is much greater and far more immediate than people expect. I wrote a whole paper a couple of weeks ago where I went in and looked at what's going on with the typical buyers of treasuries right now. Because we did see a backup in 10-year yields from 130 to 160 that happened very quickly. And I thought, okay, well, maybe this could be a sign of things to come when the Fed really implements taper. And when I went back and looked at what our big buyers were doing during that period that rates backed up 30 basis points, I came away even more terrified about the prospect for higher rates, because it turned out that foreign central banks had sharply accelerated their purchases of treasuries, even as we saw this sell-off in rates. So too had US domestic banks, our commercial banks, loaded up on treasuries, and at the same time, they backed up anyway. So when you take two of the biggest buyers and they're rapidly increasing their purchases, and yet rates still go up anyway, you get a sense as to how incredibly fragile our financing situation is. And the idea that the Fed, that is taking down roughly 1 trillion of 3 trillion annual issuance of treasuries, can just somehow say, oh, we're going to reduce our purchases and don't worry, it'll be like watching paint dry, is just laughable to me. But they didn't learn the lesson in 2017, 2018, so they're back at it again.
Wow, that's really important information, Stephanie, because I think that is not on a lot of people's radar right now. Let me put it that way. So if I'm hearing you correctly, you sort of feel like, hey, in the near term, there's more potential for rates to start rising than most people realize, and certainly the market is giving credit for right now. Let me ask you this: if they rise high enough, do you then expect that to sort of trigger some sort of correction in the markets? We might even tip into recession with a slowing economy at the same time. Then do you expect to see demand, large demand for treasuries as a safe haven? So the point is, could they come up,
Yes.
then be forced down by the correction? And then if so, where do they go after that?
Right, exactly. I mean, that's why I made the point about that. You've got to figure out that safe haven demand part of it, because it seems to me like, given the numbers I laid out earlier about the overvaluation of the market, it wouldn't take much of an increase in interest rates to have a potentially really meaningful effect on the stock market. And you would have this flight to safety that could, maybe the 10-year backs up to 175 or 180, or, pick a number somewhere just barely up toward 2. And that's enough to get the stock market down. Then you immediately find yourself back at 1% treasury yields, because you're in the midst of this sort of deflation panic and everyone's rushing in there to buy. And they're probably anticipating that the Fed's going to pause the taper and all of that stuff. I would note, this is kind of just by way of minutia, but the Treasury did just announce that it's going to scale back its issuance of coupons. So it's reducing just in time for the Fed to taper its purchases of long-dated treasuries. The Treasury is going to issue less of that paper. So presumably that means they're going to shift their funding more to the front end of the curve. So that'll be a factor as well. But I think that in general, given again the fact that the Fed was taking down a third of issuance, the potential for a sharp backup in rates that Fed isn't prepared for and the markets are definitely not prepared for, seems very real to me.
All right, and Stephanie, you're putting your finger on a big reason why we do these videos here at Wealthion. I talk a lot about, with the experts we have on here, that now is a particularly treacherous time for investors because things are so uncertain, and they have the ability to be there has the ability to be a lot of cross currents that come into play here, where things may change quite rapidly on the ground. So you really don't have the, it's sad, but we really don't have the luxury of picking a long-term strategy and just sailing through with that strategy.
Right.
We're entering an environment, we're in an environment and entering an increasing one, but you really kind of have to be nimble, because even if your long-term prediction is right, you can get wiped out multiple times along the way if you're not positioned where the wind is currently blowing.
Absolutely.
And I see you nodding here.
Yeah.
All right, I want to get to kind of the potential pins that could pop this bubble, black swans that could upend the apple cart, whatever analogies we want to mishmash together here. Before I do, though, I just want to go back to buybacks for a second, because it's something that's very important. And I'm not sure that all the viewers watching this video appreciate what a factor buybacks have been in supporting stock valuations. Or stock prices. And maybe if you could just give kind of 2 seconds on, your estimation on how much of an impact they've had on supporting prices. And also, they used to be illegal. And then they I think back in the 90s were allowed to become legal again. And of course now it's a huge amount of the volume and purchasing of many companies. How are they not sanctioned manipulation of prices?
Well, at a minimum, you'd think that they would heavily scrutinize companies that announce buybacks while insiders are selling. Like that obviously should be something that's right. And yet you see this, the timing is often very coincidental, shall we say. So it just seems like a lot of companies grease the exits for their insiders with these buybacks. But getting into the question of trying to quantify the impact, I saw an analysis just this week that ascribed 40% of the move in the S&P over the last decade to share buybacks and only 31% to earnings. And then there was multiple expansion and other that contributed to the rest. But 40%, so that was the largest contributor by far to the increase in the S&P over the last decade, according to this analysis. And I would just say, again, I really, nerd that I am, I spend a lot of time in the GDP profits figures, and they've shown really pathetic growth over a period during which the S&P earnings numbers have been resplendent. And it does make sense. You're first off, while we worship at the altar of the S&P earnings, it's 500 companies. In the United States, publicly listed companies, I mean, there are thousands, of which these 500 are just the largest. And they're the ones with the economies of scale. And they're the ones who can, find all these ways to inflate their earnings and whatnot. The basic businesses out there aren't able to do these tricks, and that's reflected in the government data that actually quantifies these on a dollar for dollar basis rather than looking at them on per share metrics. But I would just say, as uninspiring as the economic growth was leading up before we had the whole COVID pandemic, the trend in corporate profits as measured by the governments was every bit as uninspiring. And you wouldn't have known that looking at the S&P earnings numbers, which again, that's all Wall Street looks at. So they see it as a justification for pushing asset prices up to these ridiculous levels. Even though they should know better, they should be adjusting for the buybacks to get a better picture as to what's really happening in the businesses. But
wow, yeah, it is largely it's largely accounting gimmickry, right? I mean, there are some benefits where you're retiring stock that might be paying a dividend, right? And if you're borrowing to do it at next to zero, there's an arbitrage to be made there if you're the CFO. But in general, to your point, the vast majority of the effect is just accounting gimmickry, and relatively simple accounting gimmickry, but the market still kind of gets fooled by it. And 40% of the performance driven by that versus actual earnings growth, which is just crazy. Wow. All right. So let's get to those black swans. I think we've already mentioned a number of them, but It sounds like you think that there is going to be a material correction ahead at some point. I'm not going to ask you to pick a timing, but maybe you could give us, I feel like it's going to happen within the next 2 years, not necessarily saying 2 years, but is it something that could happen, near enough to matter, or we don't need to worry about it for a while? I'll just ask you to pick one side there. And then also, what's your second, general magnitude?
Okay.
Are we going to brush it off as a flesh wound, 10, 15%?
Okay.
Or could it be like a Jeremy Grantham 50%? Could it be like a David Hunter 80% fall? And then last, if you could go through what, maybe your top 3 or 4 favorite candidates for what could trigger that.
Yeah. Well, I would like to imagine, I hate to say that because like isn't the word, but I imagine that given what you mentioned earlier about all the uncertainties that we have right now, that the likelihood that this happens sooner rather than later is pretty great. I mean, if it's still 2 years from now, we won't be having this conversation because I'll be committed in some kind of insane asylum somewhere. You'll have to come visit me in my straitjacket there.
I might be in the padded cell next to you. So.
Okay. So that, for me, it seems like here we've got the Fed about to taper under the lie that taper isn't tightening, against a backdrop of unprecedented fiscal funding needs. And they're planning to kind of exit gracefully from their responsibility of picking up all that slack. I think that's one major risk. And then, of course, you've got what's happening, on the fiscal side in terms of whether this bill gets passed or not. It is going to include a lot of tax increases that are probably not going to be stimulative to growth in the economy, in my opinion. And we can talk about that more later. And then, of course, the geopolitical uncertainties are myriad. And then we've got energy prices and all of that. And, to the extent we're going woke and we refuse to produce any of our own oil, and we're demanding everyone else around the world do it, that's probably not going to reduce the, the depressing effect of higher energy prices anytime soon. So, again, I think that I would anticipate that we would see a meaningful correction, certainly within the next year, if not sooner than that. And as to magnitude, I guess, I fall between Grantham and Hunter in terms of, if you just look at that math that I laid out at the very beginning, you're talking about a correction somewhere around 60-65%, I think, to get to fair value. Now, of course, you never really get there and just sit there neatly and then go back up. So there is a chance that we overshoot, but then there's also a chance that we don't get anywhere close to that before the powers that be come rushing in with the fire hoses again. So, my hunch would be that unless we have like an October 19th where things collapse in such short order that they don't have time to come in, odds are that they'll come in and try to provide support under the market long before we get too deep underwater. But as for catalysts, there are a lot. My all-time favorite, though, and this is maybe sort of tinfoil hat type of stuff, but I really think China is going to be the catalyst for this correction or bear market. And I think that because I think that, like COVID, what's happening with China's credit, the property sector, and trying to deleverage the property sector, and the whole Evergrande situation, started out as an undesirable situation for them. It puts them at great risk economically. But they quickly have identified that this could be a real opportunity. This is my sort of sinister thinking about it, is that the calculus for China may be, yeah, it's going to hurt our economy, but Chairman Xi isn't up for election anytime soon. He's there for life. And his number one goal is to challenge US hegemony and establish China as a global economic superpower. And I think in the West, we are so cavalier and kind of flicking that off, like, yeah, whatever, China could never ever rival the United States, much less usurp our role as the world's reserve currency and the number one superpower. And I think that is dangerously naive, because again, he can take hits that our politicians have no ability or willingness to take. And if it means that they're going to deflate their property bubble and deleverage the system, which, by the way, is exactly what the tightening measures they imposed were intended to do. So, now that they're taking effect, everyone gets all hysterical about how, oh my gosh, look, they're deflating, this bubble is bursting. Exactly. That's what they were trying to achieve. No bubble deflates in smooth, perfect, controlled fashion, and they knew that. And I think people are overly cavalier as they watch what's happening with Evergrande, then then there's Fantasia, and then there's Modern Land, and we're going the parade of defaults. And the assumption here seems to be, all right, well, when it gets really bad, they're going to come in and start bailing this out and print money and do whatever it takes. Meanwhile, the yuan has strengthened faster and farther than it has in any times since they went on a managed float back in 2005. So it's a new approach. They no longer want to debase their currency to maintain export advantage to the rest of the world. They are really focused on getting their consumer economy going, handing their consumers purchasing power, rivaling the US, establishing the yuan as a hard money currency while we're at printing money hand over fist. And I think that could be the real surprise. If they let their bubble burst, eventually it's going to filter out their borders and all over the world, and we'll have a credit meltdown globally. And we are not in a position to handle that. They are, we're not. So I think that's my favorite. I mean, again, I use the word favorite, it's in a ghoulish kind of way, but that's my top black swan event, because I just don't think anyone's really focused on that.
Wow. Well, fascinating. And you just showed that you've really thought it all through. So it sounds like you think that she could basically set off the credit bomb. And his bet is, look, we're all going to get,
right,
peppered with shrapnel from this. But I'm betting that I can get up and dust myself off from that and recover much faster than these kind of bloated, sclerotic,
right,
old Western powers that, still dream it's their glory days, but don't realize that they're ending.
And I think he also is betting correctly, I imagine, that the response by Western central banks will be to immediately go back to doing what they've been doing all along, which is just printing money, but they'll do it in even more splendiferous fashion, which, when it comes to taking over the dollar as the reserve currency, plays right into their hand. Let's just get this QE on steroids globally and completely destroy the value of the dollar, the euro, the pound, and then the yuan starts to look like a viable alternative.
Right. And first off, you share that prediction, right?
Yeah, I said that. Yes, I'm actually owning it, although it sounds like something I should be standing on the sidewalk with a sandwich board. It's China's going to deflate our bubble, but I really think it's a possibility.
Right. Well, I mean, you and many others that I've interviewed recently, they seem to be relatively uniform in saying, look, when the next market correction hits, that is going to be the response from the central banks, or even, certainly if there's a credit market freeze up, absolutely they're going to go back to the playbook that seems like the only playbook that they know.
Yeah.
Right. So you just want to go back to a term you mentioned a few minutes ago. You said that you see China as trying to position the yuan as a I think you said hard asset backed currency.
Yeah.
Can you just dig into that a little bit more? So I just want to be clear, you don't want to put words in your mouth, but it sounds like you're thinking they are positioning the yuan to actually be backed by something, not just a fiat currency. And if so, what do you see it being backed by?
Well, I guess, it's impossible to prove, but
Sure.
I think that they've
You're
been,
just prognosticating here.
yeah, I think that they have been stockpiling gold, but we won't know because they're certainly not going to run out and advertise that. And they're famously coy about not reporting sales for years on end. I mean, I think that they reported sales in 2017 that they had made purchases in 2017 that they had made 5 years earlier. So they're not revealing, they're not putting their cards on the table, and probably shrewdly so. But I think that, they clearly, what they see, I think, is that they're going to need to have it backed by something. And obviously, they're making huge strides on establishing a digital currency. But I think that it's really the stockpiling of gold that strikes me as most interesting. But in general, even if they didn't back it with anything, they still, on a relative basis, are going to be in a position to look like the most responsible, currency out there, as the rest of the world is printing like crazy. So I think that, I've tried to figure out, when this bubble bursts, what will the monetary response here in the US be? We've obviously seen unprecedented stimulus after COVID, and we saw a huge stimulus right after the housing bubble burst. What could we expect if and when this market actually does revert to some semblance of fair value? And to come to some idea, I just look at that pension funding situation, which is another one of my favorite nerdy topics, and it's improved enormously, not surprisingly, during this huge boom we've seen in financial assets. But it's still $5.5 trillion. So there's still $5.5 trillion underwater. That's public and private pensions combined. That's the entire U.S. pension system.
Right. When everything is priced to fantasy, it's still got a hole that big.
Exactly, at the all-time peak in financial assets. And they've only done that well because they're buying, the junkiest of junk that they can, stretching everywhere they can to try to make those 8% return assumptions in a 1% risk-free world. So when you go back and you look at what was the monetary response after the dot-com bubble burst and the housing bubble burst to the huge destruction to pensions, because obviously, bailing out the banks isn't very popular, but you got to bail out people who worked hard and, who were promised pensions, especially in the government sector. And what you saw is that after those two bubbles, the budget shortfall, the deficit for pensions, doubled on average. So if we're at $5.5 trillion now, figure we go to 11 trillion funding deficit. That's, tack that onto the Fed's balance sheet, I guess. I don't know. If the government has to make everyone whole and then the Fed has to monetize that, again, I can just see Z doing that math over in China saying, yeah, let's burst this asset bubble and have the Fed run in and make pensions whole with the help of the government, and we'll be, all set on our path to rivaling the dollar as the reserve currency.
Right. Well, time will tell. It'll be very interesting, and no matter what happens along the way, Stephanie, we're going to want you here, chronicling it for us as it happens. Gosh, there's so many questions I'm not going to get a chance to get to. I did want to ask you about the energy situation, both in terms of the spiking prices and the shortages and the increased geopolitical competition for, a lot of these key fuels. Right now, China and Europe are in a massive bidding war over coal. And energy is so critical because, if you don't have enough energy, you can't power your economy, right? Nothing happens with it.
Absolutely.
And then I wanted to ask you too about real estate, which we're just not going to have time for. But we're seeing, somewhat like the stock market, we're seeing housing prices at all-time highs. affordability, plummeting,
Mhm.
and we're seeing investors come in and increasingly snapping up inventory, really raising the question: hey, is the average U.S. homeowner getting priced out of the market here?
Mhm.
So those are long discussions in and of themselves. If you have anything brief to say about them, please do. But let's now switch to what I think a lot of our viewers are watching or asking, which is, hey, if this is what Stephanie's thinking about the future, right? Lots of risks, potential for interest rates to rise in the near term. Maybe that's the trigger. Maybe it's China. Maybe it's whatever. But we get this. Let's say Stephanie's 60+% correction in the markets. What asset classes look favorable to you in this current environment? And also, which asset classes would you stay away from given your
Yeah.
macro outlook?
Well, I'll just tell you how I'm personally positioned.
We hope you've been enjoying this discussion with macroeconomic researcher Stephanie Pomboy. The interview continues over in part 2, where Stephanie shares how her own personal portfolio is being positioned for the market future she predicts ahead. To watch part 2, just click on the link provided in the description to this video below, or go to youtube.com/Wealthion. But before you go, please don't forget to support this channel by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it if you haven't already. It only takes a second, and it really does help us reach a lot more users. And if you'd appreciate a free, no strings attached portfolio review by a financial advisor who can help manage your portfolio with the risks and opportunities that Stephanie has highlighted here, just go to wealthion.com and we'll set one up for you. Okay, I'll see you over at part 2 of our video interview with Stephanie Pomboy.